Let me now bring on board Ravi Dharamshi to talk about markets, his big themes, some of his portfolio companies he's bullish on, and what does he make of this sudden decline or readjustment which is happening in some of the pharma stocks. Ravi, fantastic to have you back. Thank you for joining us. Well, it's been a interesting patch for the market. One side, markets are excited about what is happening to metal prices, how growth is normalizing, how new capex is coming back. On the other hand, markets are also worried about inflation and other issues which are affecting profitability and margins. So we are going through what could be called as a confusing patch.
Yeah, so Nikunj, let me just preface my answer with a little bit of macro view. You can hear me, right?
Yes, we can hear you. Yes, please go ahead. I can hear you and I can see you and I can see that wonderful poster of Wall Street which you have as the backdrop.
Yeah, sure. Thanks. So, so essentially, see, reading the macro tea leaves is always a challenging thing, as the new Howard Marks memo that has come tells you that macro forecasting is not really, something that one should be attempting. But at the same time, the way we look at it is like weather forecasting. See, you are better off forecasting the season than you are forecasting the daily weather. So one has to realize that we are in the midst of a bull market that is driven by the central bank liquidity, and it is not ending at any point soon. Now, within that ebb and flow of the larger wave, there are going to be smaller waves like opening up the economy, or is it the COVID wave that is panning out? And the beneficiaries and the companies that get affected by those things tend to perform and not perform within those smaller waves. So it might look confusing, but I think it is pretty much clear that we are in a bull market. That bit is not confusing. Which company performs at what point of time or which sector performs, that I don't think we should even attempt to make the guess.
So given at the way, Ravi, how market positioning is changing suddenly, it started with comeback in PSUs and pharma when markets recovered from the pandemic shock. Now we are talking about how startups are getting listed and they have a different business model. Have you changed your positioning looking at the way how the environment has changed?
Nikunj, no, we do not change dramatically our positioning. Our worldview did change dramatically when COVID struck. So we are still of the same opinion that it has fundamentally altered a lot of trajectory for a lot of companies and sectors. But we still continue to hold on to that view that whether it is pharmaceutical, whether it is a digitization trend, whether it is in general the asset inflation that is happening around the world, and a stronger company getting stronger will continue to roll out. So within that, there is also an added thing of a cyclical recovery, which is leading to right now a lot of cyclical companies because they have become relatively very cheap as compared to some of the secular trends. So yes, from a very short-term point of view, the cyclicals are doing better than the secular stories at this point of time. But our view still remains that we are in a secular bull market, we are in a secular trend, and one should stick with companies that are going to generate wealth over a long period of time.
Why is pharma getting smoked, Ravi? Literally, that is the word, because the fall in some of the pharma stocks, and it's been across the board, has been pretty disturbing. I mean, are the fundamentals getting changed because suddenly things are also changing on the pharma front? I mean, companies benefited because of COVID, they got re-rated. Now, the markets are saying that the COVID upside is not going to be there. US FDA audits have started. You understand pharma very well, Ravi. So why don't we spend a minute or two trying to understand that why pharma stocks have fallen, and would you be a buyer in this fall?
Very well summarize the issues the pharma is facing. So essentially what happened is they were the beneficiary of bunching up of a lot of COVID related benefit in the previous 3-4 quarters. And those benefits seems to be rolling off for the moment. as the cases come down in US as well as in India. And because of that, some amount of tapering off of the opportunity has happened. And now, along with the reopening, US FDA seems to be preparing itself, gearing itself for coming and doing physical inspection. So that really does, rear a little bit of ugly head, or reminds you of the past, that all is not well yet with the pharma industry in India. However, having said that, it is it is part of life for most pharma companies. They have gone through multiple levels of scrutiny, whether it is FDA or at client level, and they continue to being subjected to that level of scrutiny. And on a larger scale, they continue to pass out with flying colors. There will be odd company or an odd plant of a company that gets stuck due to some reason, but I don't think it's a structural issue anymore. There might be some company specific issue related to that. So some uncertainty related to FDA, some uncertainty related to continuing of COVID benefits, and underperformance of some companies in US due to pricing pressure on the drugs is leading to some money being taken off the table at this point of time. But the larger trend, I don't think is in question anymore. What is the larger trend? Since 5-6 years, we have been investing into capacities. We've been investing into preparing for the next wave of generic that are going to go off patent, and that is still ahead of us. There are some really good opportunities coming up in the next 3 to 5 years, and Indian companies are poised to take away a significant chunk of that market. So one has to position in companies which are going to do the best from the next 3 to 5 years point of view.
How sharp do you think would be this COVID adjustment? COVID upside added 5 to 7% top line to Cipla, 19-20% margin, and that significantly will change FY22 assumptions. But if one works with an assumption that the COVID upside gets limited and restricted and we will not have a third wave, we all are hoping and praying for that, what changes in the near term for pharma companies and their P multiples?
So I'm of the opinion that COVID is not going away. One has to learn to live with it. The nature of it might change. We might not have shutdowns anymore. Like Ebola is not eradicated. Ebola has become one of the virus strain, and so will COVID become one of the virus strain. And we will learn to live with it, and we will have tools to fight against it. So from that point of view, I think pharma companies have a large opportunity. And not only in India, but this is a global opportunity. And there is still a large part of the emerging markets where the vaccines haven't reached yet, the drugs haven't reached yet. So it is not the sunset in terms of COVID opportunity, but the nature will change. Yes. So we were earlier facing a situation where nobody was prepared for it. Now the capacities are coming up. Now the new age drugs that will come to fight this disease is what you have to look out for. Which companies are positioning themselves for this COVID opportunity, and in what way, which is the most effective one. So to summarize, what I'm saying is COVID is here to stay, and nature of fight will change, and we have to identify companies that are going to be at the forefront in fighting this war against COVID.
Ravi, there are two aspects which I want to discuss with you. What is happening to the global tech companies, especially the Chinese tech companies, and what it means for Indian tech at a time when Zomato is going public. How does one understand the global scenario? And then we'll talk about valuations and how to value some of the companies as the second question.
So number one is that the mega trend that is panning out in the world is the digitization. Very recently, the Google, Microsoft, everybody came out with results, and you can see that at this size and scale also, these companies are growing at 60-65%. So, and this I'm talking about the top line, the profits are growing far higher. So we are being eaten up by software, and we are being, that pace of eating up got even more accelerated due to COVID. So I don't think that trend is reversing at any point of time. Will there be some deceleration in that growth rate? For sure, that is a likelihood. So having said that, the trend is firmly entrenched. Now, what is happening is, along with this digitization trend, there are these platform companies that are taking advantage of new niche verticals. Essentially, every business is a technology business now. Food delivery business has become food tech. Banking business or lending business has become fintech. And so forth. Every business is becoming a tech business. Now, if that is the case, then the technology trend is not going to change. And in this new platforms that are emerging, the winner tends to take all is the kind of economics, the network effects, and the moat that they are building leads to network effects, and that is leading to exaggerated valuation in the short run. And of course, the push from the other side is going to be regulation, whether it is in US or in China. There is going to be a regulatory overhang where, because these companies are becoming so large and so dominant a force, that government of the day tries to control them, tries to discipline them. I don't think we are in at that stage in Indian economy where a particular tech company is dominating the space so much that they control our lives. So I don't foresee India having that kind of regulation any point soon. But maybe 5-10 years down the line, if we are also in a similar situation, then that regulation might come. But what that means is that 10 years down the line, we will probably have few companies who will be dominating this space, and that is an amazing amount of wealth to be created in this space. So leave your apprehensions aside on the regulatory front, and be a little more skeptical of the valuation, but don't throw them out of the window just because they are not making profit or cash flows, and they are focusing on the 10-year period, not the immediate next 1 year.
Okay, Ravi, as a framework, the one thing which you follow is the size of the opportunity. What is the size of the pond? Is it expanding? Is it contracting? We'll also flash your top holdings here, and your top holdings, they are Pharma, Root Mobile. The management would be joining us. I'm going to make it clear for our viewers here, disclosure that the two companies which we would be discussing with Ravi, they are part of his portfolio companies. Those portfolio stocks will just come up on your screen. So Ravi, let's understand two themes where, according to you, the size of the opportunity is expanding, which is that 2 years out, 3 years out, 5 years out, the entire business proposition is going to be significantly larger.
Right. So clearly, digitization is one place where the opportunity is expanding and accelerating at an unprecedented pace. So we are probably now nearly 70% of the world has mobile phones, 50% of the world has internet, and they are all connected. And the opportunity size for most of these global tech companies is not their specific geography anymore. They are catering to the whole world, except maybe China, because China is still a walled garden, so to say. They do not allow other tech companies to enter. So there's a large geographic opportunity. There is a large, the models are such that you can actually address the global audience, and the technology has enabled that. So we have to figure out how to ride this digitization trend that is panning out world over. And there are many small niche verticals within this digitization trend that are giving rise to companies that dominate that particular vertical, and those are also large enough to have companies growing to be 5, 10, 20, 25 billion dollar kind of companies. So yeah, that is clearly one of the biggest trend that is playing out in the world right now.
Why is there is no financial name in your top 5 holdings? The weightage of financials in Nifty is 35% plus now. At least the top 5 holdings which we have, I don't see a finance name there. Or until unless I have the holdings wrong.
It is not in the top 5. Yes, we are a little underweight on the financials, but that is because I don't think we have reached a stage where the capex cycle begins. There is a little bit of the consumer in India is actually facing the brunt of the COVID, and the spending is getting redirected towards other things. And MSMEs are also suffering because of COVID. So little bit of tension on that front, and also the fact that the capex cycle hasn't yet begun and probably it is still 4-6 quarters away, is leading us to for the reason that we are underweight. But that underweight could be changing going forward. It's just the present status. I would like to just put that caveat in.
You talked about digital, so let's understand. One is enabler, second is hardware provider, and third is the beneficiary. How can one bet on this entire digital wave and bet on a beneficiary? Because ultimately the benefits will also be captured by the beneficiary or a company who's adopting digital and enabling platforms or services or customer experience using the digital platform.
Absolutely. In the adoption curve, usually it is the shovel sellers that benefit first, and for sure. So the eventual benefit of the technology might be realized by the consumer at some point of time. When I say consumer, I'm talking about the companies that are consuming the technology, and that benefit will take some time to percolate down to the shareholder wealth creation. So at this point of time, you have to look at companies that are enablers and who are riding this wave at the crest. So we have to go after the shovel sellers or the enablers of this opportunity at this juncture, because the opportunity is still unfolding. The technology is still evolving, and the winners are not yet very clearly known in each and every space. They are in a much more formed, shape and size than they were probably 10 years back. But still, it is a very fast evolving space in terms of technology and in terms of business model. And the good thing for us as an Indian shareholders or Indian investors is that we can see those trends unfolding in other geographies, whether it is US or China, and see that similar kind of a trend is going to pan out over here. So we have some benchmark. It becomes easier. We just have to look for companies that are emulating them, and you can have a good winner over there.
Ravi, let's talk about your portfolio companies with the disclosure that you have vested interest in them. You have a large investment in Laurus Labs. What excites you as an investor about Laurus Labs?
As you have put the disclaimer in, and I would also like to add that we are likely to be acting contrary to whatever gets spoken over here. This discussion is purely for illustration purpose and as an example. So, and the decision that you are asking about is something that we took almost a year back. So what got us excited about Laurus at that point of time was that it had invested ahead of curve. It had leveraged itself. The company and the promoter both were leveraged, and it had created the capacities, and the costs had been borne, but the fruits had yet to come. Now it's just happens to be luck that COVID struck, and that just accelerated the opportunity for them. Besides the fact, they were also they are the largest ARV API company, and there was a big shift happening in the ARV market where the treatment was moving away from the last gen to the next gen, which is from TLD to DTG, dolutegravir, and that they were very beautifully positioned to take advantage of that. So that was the immediate trigger. Besides that fact, we always admired Dr. Satya in terms of his technical capabilities and his risk-taking abilities. So here was a company that was really positioned to take advantage of the coming wave, and market was very skeptical about it and was not giving any valuation. In fact, it was giving low multiples to a very subdued P&L and balance sheet. So that is why the returns have been so big, because suddenly the P&L as well as the balance sheet has improved dramatically in the last 4 to 6 quarters.
Okay, the management joins us now. Let's take our conversation forward, and of course Ravi will be part of it. Dr. Satyanarayana Chava, founder and chief executive officer, joins us now. Mr. Chava, good morning. Thank you for being part of Big Picture. Ravi is part of this Big Picture episode. So he will also be asking you questions. But before Ravi becomes part of the firing squad, let me first understand what market expectations. Let me first share with you that what market expectations are. Markets are expecting that the trajectory of margin improvement what Laurus has exhibited in last couple of years, that is here to stay, and with each passing quarter your margins and your product portfolio will only improve. Are expectations realistic or they are stretched?
Good morning. As we demonstrated in the last 6-7 quarters, we have diversified our revenue base significantly, and we invested in capacity ahead of what we need, and we employed a team and we invested into facilities. Our investment in R&D also very high when compared to other generic companies. And all these expenditures are expense. So none of these expenditure was capitalized so far in the R&D. When we invested heavily, our numbers looks not that interesting. But when we are seeing the fruits of those investments, the R&D percentage as a percentage of revenue, R&D expenditure came down significantly. Our employee cost came down significantly. In fact, thanks to our finance team, our cost of finance also came down. There was operational leverage. So our EBITDA numbers improved significantly because of the investment what we made earlier into R&D, product development, capacity enhancement, registrations and all. So once the base is set, we do hope we have the ability to maintain the margins. As you have seen, our gross margin is at least constant, if not improving. And we made it amply clear that we have the ability to maintain EBITDA around 30%, despite of our growth in the coming quarters. All this was possible because of increase in revenue from high margin businesses, especially our CDMO business. And also our formulation business is fully backward integrated. That also gives more margin than our pure API business. So as our revenue share from CDMO and formulations goes up, our margins will definitely improve, and we will maintain our EBITDA percentage.
Dr. Satya, if I were to come in here, hello, good morning, sir. How are you? Ravi here.
Good morning, Ravi. How are you?
Good, good. It's pleasure interacting with you on air, sir.
Same with us.
So, Dr. Satya, you have been a risk taker in your life. You left a cushy job with a large pharma company at the peak to start your own venture. You got a P guys to back your idea. I remember you, in fact, actually went and joined an management institute to do your MBA while in the middle of a successful career. You leveraged personally and you leveraged the company also, of course, with the foresight that the opportunity is up ahead and you're enjoying the benefits of that. So my question is, how should an investor look at you? Are you a maverick risk taker, or are you a calculated, opportunistic player, or are you like an engineer who's building a large pharma company out of India? How should one look at you?
I wanted to clarify, Ravi, we are not a risk takers. We plan well in advance into development, into capacities. The capacity enhancement is not a risk taking. Yeah. The risk taking in pharma industry is trying to scale up a not so well developed process. That is a risk. We don't take that kind of risk. As you have seen, our facilities are best in the class, and our regulatory track record is impeccable. So there are areas where risk is not allowed. One is quality, safety, regulatory. We don't allow anyone in the organization to take risk. Where we take risk is when we need capacity, say 2023, sometimes we build 6 months ahead of what we need. That is the kind of risk we take. We take risk to invest significantly in capacity. As we speak, we announced FY22 and 23, we have plans to invest to anywhere between 1,500 to 1,700 crore in capex. We are increasing our API capacity by 25% in 1 year. To build 1 million liter reactor volume, initially we took 8 years to go to 1 million liter reactor volume. In the current time frame, in 18 months, we are creating additional 1 million liter reactor volume. To go to 5 billion tablets capacity in our formulation, it took 7 years for us. Whereas in 12 months' time, we are creating another 5 billion tablet capacity. If you consider these are the risks, we don't believe these are risks. These are the investment for us to grow and capture the opportunities. I want to make it very clear. We are risk takers in certain areas. We are risk averse in certain areas. Safety, quality, regulatory, no risk. Whereas capacity enhancements, product development, and investment into R&D, investment into new technologies, we take risks. And those are risks paid off. And we do believe those will pay off in the future as well.
Thank you so much for that response. That makes it very clear that the risk we take is not any kind of an existential threat to the company or any kind of a regulatory risk, but it is only the market and the technology that we are going to focus on, where we invest ahead of the curve. So one more broad question to complement that. So that is how you are. But the company that you started, you actually crunched the timeline. What you have achieved in a span of 12-13 years since the company started is far more than what some of the other companies have achieved in 50 years of time frame. And you started off being an ARV API company, then you moved on to becoming an API company, and now you are moving on to becoming an API pharma company, formulations company. And I'm sure the next 5 years are going to be different than what the last 5 years were. So if you can just give us some sense of where we are in this journey, will there be a transition period involved to getting whatever the next stage is and what that next stage is?
You described very well, Ravi. From one product, ARV company to ARV API company to API company and pharmaceutical company. We are a pharmaceutical company right now. But the kind of efforts what we are doing internally will be visible to all the stakeholders in the near future. The amount of investment we are planning to do to focus on our CDMO business is sometimes we internally discuss what we are doing is not enough. We are creating 4 new manufacturing locations for our CDMO business, and we are building a new R&D for them. And we are recruiting business development teams. We are strengthening their team. That area where we are committed to invest whatever is needed. So significant change, all of you will notice in the near future. The kind of opportunities we are pursuing, the kind of business we started working, and we will bear the fruits soon. The other area where we are also investing into, we were known as a scale player in APIs. We are also known as a scale player in formulations. But we started working on complex scale projects. So I want to reiterate, we like scale and we are adding complexity to the scale. So we have several products in our pipeline where the volumes are very high, but complexity is also very high. So we are investing in product development, we are investing in capacity ahead of what we need. So our investment into new delivery systems, our investment into complex generics will definitely make us unique where we offer scale and complexity as well. That is one. The other investment where we are continuing to do is strengthening our technological base. We have a very good expertise right now in the pharma industry on chromatography. We do large chromatography for generic customers. We do large chromatography services for big pharma. And we are also entering into continuous flow reaction. We invested significantly already. We will take some of the reactions commercially in the near future. So, answering to your question, in the next 5 years, you will see us as a well-diversified pharmaceutical company and an emerging CDMO company. So, over a period of time, you will see us giving separate independent focus on generics. Both the APIs and formulations will be one part, and then CDMO is another part. What you will also see our investment into bio, our new edition, Rich Core, which we named as a Laurus Bio, will also see significant ramp up in their offerings, especially in the recombinant food proteins, cell culture ingredients. And we are already looking at land to expand capacity both in Karnataka as well as in Andhra to set up additional fermentation capacity for backward integration into chemical intermediates as well as fermentation into food proteins. So a lot of excitement within the organization, what we are doing right now. As we always speak internally, we are still a startup. So we think like a startup company and a lot of excitement within our team right now.
Right. Dr. Chava, pharma is one space where there are two challenges. Number one, there is price volatility. That's the nature of pharma. API prices, they go up and down. Bulk drug prices, they go up and down. And second is this entire supply chain which is changing because of the China plus strategy. How convinced are you for the kind of expansions which you are doing for next 3 to 5 years, because you're sounding reasonably bullish, that the template which you are working with, it could get challenged either because of pricing environment or because of changes in supply chain?
Generic industry thrives on two things. One is regulatory compliance, second is cost. And if company supply chain is well managed and they can cope up with the challenges of supply chain. And the one you are mentioning of pricing pressure, companies who have leadership position in the products, they put the trend. They set the trend. They don't follow. So for leadership products, we put the benchmark. We put the benchmark based on our ability to offer value to our customer, based on our technological improvement. See, we do work on process improvement continuously. If you look at our number of DMS files, we don't have a big DMF list. We have one of the largest generic R&D in the country. But if somebody compares us for the number of DMFs we file, we are very inefficient when somebody looks at it. But our ability to improve processes, add value to our customer is very much visible in every product what we do. So you have to look at companies on how many products they have leadership or how many products they are aiming to get leadership position. Those products, companies only will set the trend and somebody has to follow. We believe this China plus one strategy is a long game to go. Because see, somebody cannot start offering a product which is available at $100 and India at $110. Nobody will buy. So we have to be competitive to not only local companies to become competitive. We have to aim global companies as well. As we speak, we sold more than $10 million worth of APIs and intermediates to China. So we see it the other way. We see China as a good avenue for us to grow our API business. We're thinking differently. We were seeing China as an opportunity rather than China as a threat.
Okay. Well, Dr. Chava, on behalf of ET Now and on behalf of Ravi and his team, thank you very much for being part of Big Picture. We wish you good luck. Keep up the good work, and the way you've really outlined the big picture scenario for our viewers and for your shareholders. Really appreciate that. I'm just going to mark markets. Meanwhile, while the management of On Mobile is getting ready, markets, well, we are stuck in a range. You draw a flat line, almost like a vertical line, and that vertical Nifty actually has just been range bound. In last 1 month, Nifty has frankly done precious little. Ravi, the next portfolio company which we would be discussing is Root Mobile. Now, you've been an early investor, is what I understand, in Root Mobile, right from the IPO day. While we can argue about tech is one space where disruption is real, for those who are disrupting, they like it, and for those who are getting disrupted, they don't like it. What gives you the conviction of being invested in a tech company which is a disruptor, and where you have the likes of Google and Amazons, which in a sense are just changing the rules of the game?
Yeah, so Nikunj, the first thing is, unlike most other tech companies, Root Mobile doesn't burn cash. So that was the first thing that attracted us. In fact, the company has been set up with barely 6 lakh rupees capital, bootstrapped from 6 lakh rupees capital. So it is a profitable model. It is the unit economics were very, very attractive, and their strategy was to build their, bolster their balance sheet and try and go for scale. So that is what we like. So you are right. We can never be very sure which way the technology is panning, and the twists and turns of technology can end up disrupting the disruptor as well. But at this point of time, that is what we will try and gauge from Rajdeep ji, whether how successfully we are riding this wave. So good morning, Rajdeep ji. Thank you for joining us. It's a pleasure interacting with you on this platform.
Good morning, Ravi. It's a pleasure of mine, sir.
Yeah. So, Nikunj, if you don't mind, can I go ahead with my first question?
Yes, please go ahead.
Yeah. So, Rajdeep ji, in tech, it is all getting down to who has the scale, who is becoming the big daddy of the space that they are operating in. So, and not the advantage of that is scale begets scale. It leads to faster, not only organic growth, but it gives you the currency to do inorganic growth. You can get top talent, and as you grow, you muscle out some of the other smaller players. So my question to you is, in such a space which is so hot and it is growing fast, where the industry itself is growing at 40% plus, why are we guiding for a 25-30% growth? Why are we being conservative in acquiring? And so we have taken a lot of steps in terms of getting new talent and trying to seed new markets. Just want to understand your broad thought process on what is our game plan in making sure that we have the right to win, even though we are at the right place at the right time.
Thanks, Ravi. I think to start with, I think the scale is definitely one area, but at the same time, you need to have a scale along with the innovation, because scale is only going to sustain longer period of time if you have an innovation along with it. And we as a company always believe that we need to make sure that we innovate along with our scaling. And if you see from last 3 years, we invested heavily in various channel of communication, starting from RCS, email, voice, so Root Mobile is not just a messaging company. I think in our Root Mobile now we have changed our stand. We say that we also do messaging, which means that SMS is just a part of our offering, And in terms of a disruption, if you see, most of the company like Google and Facebook, and top 10 tech giant of US, they use my platform. In fact, they rely on my platform, and we work very closely with these tech giant, whether it's a Facebook or a Google, where they are launching new APIs for the market, such as RCS or WhatsApp APIs. They need companies like Root Mobile who already have a large customer base, where they want people like us to just go and build an API for them, solution for them, and scale their APIs. So we as a company are always there to make sure we give a conservative guidance to our people. And if you see our 3-year trajectory, I think we always achieve over 40% of growth. And we are very sure we will overachieve this year as well. And but based on certain market current pandemic condition, where we see there are certain market or verticals are not doing well, And I think probably if all goes well, we might upgrade our guidance in next quarter.
Okay, great. That was good. This thing. Just one follow-up question to that before I hand it back to Nikunj to ask you questions is having a strategy and having the resources to do the execute a strategy is one thing, but actually executing, achieving the scale is a challenge that you face, and growing at the same time executing larger and larger projects, multi-geography projects, and interacting with diverse set of clients, acquiring talent, all happening simultaneously is, I'm sure, is a challenge that you are going through right now. If you can give us some sense of how you are managing that challenge and how we are getting up to be a much larger company than we are currently.
So Ravi, if you see our structure, like we have a various executive team based out of all different markets. Like we have Vikram based out of US and reporting to John based out of Europe. So now John recently joined from Mastec, and he's going to lead the entire Europe, Latin America, and US market for us. So if we do any inorganic acquisition in that part of the world, or if we want to grow ourselves in terms of sales via our product team in that market, that entire team is going to report to John. If you go back to our Middle East and Africa market, so we have a Sharad. Sharad is responsible for that entire market. If you come to India, then there's a Tushar Agnihotri who's responsible for India and APEC market. So we have this leadership team built in, and we have a team below there, and all of them report to us. It's very simple. If I want to grow, want to scale our business in Latin America, the first thing is a platform. The platform which we have built, the connectivity which we have with operators already been established. What I need to maybe acquire a company in some part of Latin America, immediately I will have all the companies like international customer like Google, Facebook, they will start using my platform along with the current local vendor, local company. So for me, scaling is not a problem because we already have a platform which works all across the globe. And in our business, the platform plays a very big role. And that is the reason probably I can say that we are the only company based out of Asia who has that kind of evolved platform with that kind of 800, 900 operator connectivity with the 260 operators, a direct partner. So I think that is a scale and that is the mode we have built, and which is very impossible for anybody to come and replace.
What are the technology gaps which you need to build or acquire so that the transition from being a transition really is smooth for you and you are able to take a change in your orbit where you can leapfrog from the current orbit to a different orbit?
Nikunj, probably if you see Root Mobile, like there are certain area we have which we build, certain technology which we build in-house. So we have a very large R&D team of our own. At the same time, there are certain evolved platform we recently acquired for email, like from a company called as Serve. And we are rebranding email, that platform as a SendClean. We already got a company registered in US as a SendClean Inc. and in India as SendClean Private Limited. So we know the potential of email is going to be almost $17 billion all across the globe, and India itself is $1 billion market for email. So I think we were always looking for a platform which is evolved, which is scaled, and we want to integrate the same platform with our platform. And with this acquisition, I think probably what we are trying to build now is a separate SBU for email itself, which will we are planning to invest about $12 million in this SBU. And we will have a separate team, and we're directly planning to compete with the companies like SendItBlue or SendGrid or we say SparkPost. Because see, it is all about your IPs, which plays a big role in email business. It's all about your infrastructure, which plays a big role. Our servers are already hosted in various parts of the world, and we have already serving customer all across the globe through that platform. What we need is more marketing, more team. I think that is where we need to focus on email area, which is definitely going to create lots of value for us. The other area for us is a customer experience. Like if you talk about the conversational AI today, it is nothing but just like your WhatsApp messaging or RCS, where you say when you talk about SMS, it's just an impression. When you talk about RCS or WhatsApp, it's a conversational. The moment you move to the conversational AI, it is nothing, it's not a great rocket science. When people talk about AI and ML, it is all about just a technology. End of the day, you are feeding data to your AI ML base, and that exactly how it is working out. But AI ML can actually solve your 30 to 40% problem. At the end of that conversation, you need a live agent. The live agent mechanism is always going to be there. You cannot say that we are going to replace live agent from the entire contact center management platform. What we are looking out as to build or acquire a company in this space, which is going to definitely add value to our platform, which is from CPaaS to CXPaaS, which is very, very important for us. And that is exactly what we are looking at. And in coming uh, quarters or 2 quarters, probably we want to get into the CXPaaS module, and that is the two areas we are very bullish about. So email and CXPaaS is what we are focusing right now. And in terms of our in-house development, if you say RCS or if you say WhatsApp, I think we built everything within our company itself. And we do see lots of adoption of RCS happening in India. As we shared in our last presentation, like we did over 300 million transactions over RCS, which is very, very, good in terms of people adoption. So it's enterprises are willing to change their adoption in terms of how they want to communicate with their end user. That is the key right now. It is not about just single SMS coming, which is just an impression on your phone. The enterprise want the customer to reply. And for that, I think the kind of new technology which is coming up, we always call it RML, SMS 2.0, which is RCS. And RCS has a great future in coming year. And we are the early adopter. We have been always a part of Google with this initiative, and we have been always got a very good feedback, very good support from Google, and Google also appreciate our effort in this space. So we do see this is going to change, and people are going to definitely adopt a new way of communication, and where they want to make sure they communicate better. And in return, if you see, the enterprise is also definitely looking out to have a better way for communication, better way to engage their customer. And I think the digital platform like Root Mobile is going to solve all their problems.
Well, Mr. Gupta, you've been very vocal. You've detailed the business model. I'm sure Ravi's conviction, which is there, will only get cemented now that you've indicated to our viewers and to our shareholders that you're looking at increasing your guidance. So really appreciate your time, and thank you for being part of Big Picture. Ravi, before I thank you for being part of Big Picture, let me ask you a trick question, Ravi. We've spoken about your top 5 holdings. Now, I'm not getting into specifics, but based on the management interaction of NATCO and Root Mobile, which are part of your top holding, how much of your top 5 holdings in the next 2 to 3 years are likely to change? What happens tomorrow, we don't know, but based on your today's assessment.
So Nikunj, I really wish I knew myself. I'm going to let it pan out as it pans out. At this point of time, there is no intention to change this. It will happen as we progress, and we'll let the fundamentals dictate it rather than trying to anticipate anything.
You're giving me a politically right answer, not a specific one. You asked very specific question to the managements of your portfolio company. You're dodging my specific question.
And honestly, that's an honest answer. I have no idea. I'm not looking to sell any of them with a 3 to 5 year view. But as fundamentals change, we will keep changing our view.
Really appreciate that. And just on behalf of everyone from ET Now, thank you for being part of this Big Picture. It was a very engaging conversation which we had first with you and with some of your portfolio companies.
Thank you. Thank you.